Welcome. In this explainer, we're diving deep into BGVC's latest analysis of Salesforce's Q3 earnings. And let me tell you, this wasn't just another report. It might have just changed the entire game for the software giant.
Okay, so let's just get right to it, the massive question that's been hanging over the entire software industry. The market, for its part, seemed pretty sure it had the answer for Salesforce, and that answer was a big yes. But as we're about to see, the reality is, well, it's a whole lot more interesting than that.
So first, let's set the stage. Let's talk about what everyone was thinking before this earnings report dropped. The consensus was that Salesforce was, a legacy giant, a relic of a past software era that was staring down an inevitable decline.
The thinking on Wall Street was pretty simple, and honestly, pretty brutal. New generative AI tools were going to make traditional software cheap, maybe even obsolete, and Salesforce, the undisputed king of the subscription model, was standing right in the crosshairs.
And if you want to see that pessimism in a single number, here it is, a 29% drop in the stock year to date. I mean, this wasn't just a market correction, this was a total vote of no confidence. The market had basically decided that Salesforce's best days were long gone. But then, the Q3 report landed, and wow, the data told a totally different story. This wasn't just a good quarter. According to BGVC's analysis, this could be a historic turning point, not just for the company, but for the entire industry.
The first shockwave? Just look at the profitability. Earnings per share didn't just beat Wall Street's expectations, they absolutely crushed them by almost 14%. That signals some incredible financial discipline, even as they're pouring money into AI development.
Okay, now this is where it gets really, really interesting. This slide shows you the real engine behind that surprise. Forget that old idea that AI can't be monetized. Agentforce, their new AI product, just crossed $500 million in recurring revenue. And get this, it's growing at an incredible 330%. You combine that with their data platform, and suddenly you're looking at a $1.4 billion AI business that's more than doubling every single year. So what exactly is this new engine? Well, it's the heart of what BGVC is calling the Agentic enterprise, and it represents a fundamental shift in how businesses are going to operate from here on out. So this is absolutely crucial to understand, the difference between a copilot and a true agent. A copilot is basically an assistant. You have to tell it every single step to take. But an agent is an autonomous worker. You just give it a high-level goal, something like, hey, resolve this customer's shipping issue, and it figures out all the steps and gets it done on its own. Salesforce isn't just building a better assistant. They're building an entire digital workforce. This new model works in 3 simple stages. First, you've got the data cloud, which is the fuel, right? It brings all of a company's information together. Second, you've got the Agentforce brain, which is the decision-making engine. And finally, the core sales and service clouds act as the hands that actually go out and do the work. It's a complete end-to-end system for automation. And this is the revolution in their business model. It's brilliant. Salesforce isn't just selling software to the IT department anymore. By automating actual human work, they're now tapping into the multi-trillion-dollar global budget for labor costs. That just completely changes the scale of their potential market. It's huge. So, with this new reality laid out, the analysis naturally turns to the money, and what it sees is a massive disconnect between how Salesforce is performing and how its stock is actually priced.
Which brings us to the core investment question, right? The market had priced Salesforce for a slow, painful decline. But now, after seeing this incredibly powerful pivot to agentic AI, you have to ask, does the current stock price reflect this new explosive growth story?
Let's just look at the numbers. Salesforce is trading at a forward price-to-earnings ratio of about 20. Basically, the market sees it as a slow growth, maybe even a boring value company. Now, compare that to Microsoft at 35, or ServiceNow, which is trading at a sky-high 99 times earnings. The analysis here argues there's a huge valuation gap. The market just hasn't caught up to the new reality yet.
So based on this massive disconnect, this powerful new AI growth engine combined with a deeply discounted valuation, BGVC's analysis comes to a pretty clear conclusion: a strong buy rating and a price target of $325. That suggests some pretty significant upside from where it was trading before. But of course, no investment is a sure thing, right? It's really crucial that we understand the potential headwinds here. And the report is very clear about what could go wrong. So what are they? Well, there's the technical risk of AI making mistakes or hallucinating, which could erode trust. There's the business risk of trying to integrate the massive Informatica acquisition. Then you have the big one, the threat of a global recession that freezes IT budgets. And, there's also the long-term question of whether these autonomous agents will eventually cannibalize the very human-based software seats that built the company.
But when you step back, the final takeaway from the analysis is that the entire narrative has fundamentally changed. The debate isn't about a mature, boring CRM provider anymore. It's about a cash flow rich, low valuation giant that just might be holding the keys to the next generation of enterprise AI.
So it really all boils down to this. Was this blockbuster report just a fluke, or was it the true beginning of a brand new era for Salesforce? The market was clearly pricing in the past. This report points to a very, very different future. The question now is, what do you see?